You know, the market has a funny way of teaching you what no man can explain in words. You can read every book, chase every chart, sit in front of the tape for years, and still, the market will humble you when you least expect it. But once you begin to understand its rhythm, once you learn to wait for the right setups instead of chasing every little wiggle, that's when the picture starts to clear. Today, I want to talk about something that ties directly into that, a high win rate strategy. And if you remember the previous video on cut losses, let profits run, this one's the natural next step. Because after you've learned how to protect your capital, the next lesson is how to make it grow the right way, methodically, decisively, and with precision. You see, people always ask me, Jesse, what's your winning strategy? How do you pick trades that actually work? And I tell them, there isn't a secret formula carved in stone. The market doesn't pay you for being clever, it pays you for being disciplined. A high win rate strategy isn't about winning every trade, it's about stacking the odds in your favor so that, over time, your edge becomes inevitable. Ask yourself, do you really need to win every trade to make money? No, of course not. You just need to lose little when you're wrong and win big when you're right. That's the whole game. Now, when I talk about a high win rate, I don't mean some magical 90% accuracy nonsense you see floating around. Forget that. I'm talking about a repeatable setup. One you understand so well that you can see it forming before it's obvious to the crowd. It could be a breakout that holds above resistance, or a pullback that finds volume support. Whatever it is, you've tested it, lived with it, and trust it. Because if you don't trust your setup, you'll second guess it when it matters most, and when fear walks in, profit walks out. Think about this. How often have you seen a trade setting up perfectly, and you hesitated? Maybe you told yourself, I'll wait for one more confirmation. But by the time you acted, the move was gone. Or worse, you jumped in late, and the market slapped you back down. I've done it myself more times than I care to admit. The lesson. The high win rate isn't about guessing right, it's about preparing right. You win in the planning, not in the moment of execution. That's what most traders never understand. Every great trading setup has three things: timing, price, and volume. Miss any one of those, and your odds drop. When all three align, you've got the wind at your back. But here's the thing. Your job isn't to predict when that alignment will happen. Your job is to recognize it and act without hesitation when it does. The market rewards clarity and punishes doubt. So, let me ask you, how clear is your trading plan, really? Can you describe your edge without looking at a chart? If not, you're gambling, not trading. A lot of traders mistake activity for progress. They think more trades mean more opportunities, more chances to win. But that's not trading, that's restlessness disguised as effort. The high win rate strategy is built on selectivity. You wait for the eighth setup. You don't touch the B or C trades just because you're bored. I learned long ago that money is made by sitting, not by trading. Waiting for the perfect trade is the hardest work in this business. The market will test your patience every single day, but patience is what separates the professional from the hopeful. Now, let's talk psychology for a moment. You can have the sharpest system in the world, but if your mind isn't trained, you'll sabotage it. Fear makes you sell too early, greed makes you hold too long. Hope makes you average down when you should be cutting loose. Discipline is the bridge between strategy and success. You can't have a high win rate without emotional control. The two are tied together like lungs and breath. Ever notice how the best trades feel uncomfortable at first? That's because they require courage, not comfort. And speaking of courage, remember what we talked about in that last session. Cutting losses and letting profits run. The two ideas fit together like twin blades of the same knife. If you can cut losses quickly and let the winners breathe, your strategy naturally becomes higher in win quality, even if your win rate isn't astronomical. That's the paradox of trading. You don't need to win often, but you need to manage yourself like you do. A real high win rate isn't just a number. It's the consistency of execution, the mastery of your own impulses. Most traders spend their lives chasing new indicators, new gurus, new shortcuts. But the professionals, the ones who last, they spend their time refining what already works. They study their charts, their entries, their exits, until they can smell the market's intention like a hunter reading the wind. Tell me, when was the last time you studied your own trades as seriously as you studied someone else's system? Be honest with yourself. The answers are usually in your own data, not in another man's theory. The beauty of a true high win rate system is that it grows your confidence, not your ego. Every winning streak should make you sharper, not cockier, because the moment you start thinking you can't lose, the market will remind you who's boss. I've seen fortunes made and lost on overconfidence alone. That's why I always say, trade like a machine, think like a philosopher. The market doesn't care how you feel. It only respects consistency. And don't confuse luck with skill. A few good trades can fool you into thinking you've cracked the code. That's when danger creeps in silently. Real consistency shows itself over dozens, hundreds of trades, when your edge proves durable through volatility, through sideways action, through uncertainty. A high win rate is a mirror that reflects your habits, not your hopes. So look closely. What's it showing you? Remember this, the tape tells you everything you need to know. Your job is to listen, not to argue. When the market speaks, you obey. That's how you survive the rough days and capitalize on the good ones. Because when you align discipline with opportunity, the market becomes your partner. Not your enemy. But to get there, you must train your eyes to see what others miss, and your mind to wait for what others rush into. I've always said, there's nothing new on Wall Street. The patterns you see today are the same ones I saw 100 years ago. The faces change, the technology changes, but human nature doesn't. Greed, fear, impatience. They're the same devils, just wearing new clothes. That's why a high win rate strategy isn't really about the market. It's about mastering yourself. So when you look at your next trade, ask yourself, am I entering because it's there or because it's right? The answer to that one question could make all the difference between a lucky streak and a lasting career. A high win rate strategy isn't built on random guesses or emotional reactions. It's built on alignment. And when I say alignment, I'm talking about the harmony of three elements that govern every successful trade: timing, price, and volume. Miss one, and you're out of tune with the market. Get all three right, and you're playing in rhythm with the market's music. That's when the odds shift quietly in your favor, and that's when the market begins to reward you for your patience and precision. Now, let's start with timing. Timing is the heartbeat of the market. You can have the best setup in the world, but if your entry is too early or too late, you'll find yourself fighting the current instead of flowing with it. Traders often talk about catching the move, but what they forget is that every move has a sequence. The market builds energy, then releases it. It tightens up, then breaks loose. Your job isn't to predict when that will happen. It's to recognize the moment it does. Ask yourself, how often do you enter a trade because you think it's time, instead of waiting until the market shows you it's time? That's the difference between trading on impulse and trading on confirmation. The great irony is that most traders want action, but the market pays those who wait. Real timing comes from observation, not anticipation. You watch the tape, you read the patterns, you sense the shift in momentum. It's like watching the tide. You don't fight it, you wait for it to turn. Once you learn that rhythm, your entries stop feeling like guesses and start feeling like responses. And that's what professional trading really is. A series of calm, calculated responses to opportunity. Then comes price, the simplest yet most misunderstood element. Price is the purest expression of value and sentiment. It reflects what the crowd believes right now, not what you think it should be. Every tick, every bar on the chart is the result of someone buying and someone selling, and the collective emotion behind the tug of war. Traders get into trouble when they argue with price. They buy because it looks cheap or sell because it looks expensive. But the market doesn't care what you think is cheap or expensive. The only truth is the movement of price itself. When price breaks above resistance with conviction, that's the market telling you strength is entering. When it fails to hold support, that's weakness whispering a warning. Learn to read those signals as messages, not mysteries. The best traders I've ever known didn't predict where price would go. They reacted when price revealed its intention. And here's the thing. Price doesn't move randomly. It moves in waves of accumulation and distribution. When you align yourself with those waves, you stop fighting the market and start flowing with it. Now, volume. This is the hidden force behind every move. If price is the story, volume is the voice telling it. Volume confirms whether the story is believable or not. When price breaks out but volume is thin, that's a whisper. When price breaks out on heavy volume, that's a shout. Volume tells you the conviction behind the move. It shows you whether the big players are stepping in or stepping back. And let me tell you something. No major trend ever starts without volume leading the charge. Too many traders look at charts like they're flat pictures. But charts are living, breathing reflections of participation. Volume is the pulse that tells you how alive that move really is. When you see price climbing but volume fading, it's a warning that enthusiasm is drying up. When you see a pullback on lighter volume, it's often just a pause before the next leg up. Understanding that distinction can save you from false breakouts and premature exits. Now think about this. Timing, price, and volume aren't separate. They're interconnected. Volume confirms the truth of price. Price reveals the direction of timing. Timing determines the precision of both. When you put them together, you're no longer guessing. You're measuring the market's pulse with accuracy. Every great trade setup is like a chord. Each note must be in tune. If timing is off, even the best price levels won't hold. If volume doesn't confirm, even perfect timing can mislead you. This is why discipline matters so much. The temptation to trade without alignment is constant. The chart flashes, your heart races, and you convince yourself that this one looks good enough. But good enough is the language of mediocrity. Professionals don't settle for good enough. They wait for synchronization, for that perfect balance where timing, price, and volume all line up like stars before dawn. It doesn't happen every day, but when it does, you'll feel it in your gut. The tape will speak clearly, and hesitation will disappear. It takes years of watching to see these alignments clearly. You begin to recognize when volume is leading price, when price is faking a move, when timing is premature. The patterns repeat, but your eyes have to be trained to catch them. You start noticing how strong trends always begin with quiet accumulation, subtle increases in volume while price stays range-bound. Then, one day, timing clicks, the breakout hits, the crowd wakes up, and the move unfolds exactly as it should. That's not luck. That's preparation meeting alignment. So, when traders ask me, "What's your secret to a high win rate?" I tell them, it's not about finding more trades, it's about finding the right ones. The right trade feels effortless because the market is already moving in your favor. You're not pushing, you're being carried. That's what happens when timing, price, and volume agree. You're no longer forcing your will on the market, you're cooperating with it. Think about it this way: if price is moving up, but volume isn't confirming, what does that tell you? It tells you enthusiasm is shallow. If volume surges but price goes nowhere, it means there's conflict. Buyers and sellers are locked in battle. Timing, then, becomes your compass. It tells you when that battle has tipped in one direction. When all three fall into place, your trade becomes more than a guess. It becomes a probability rooted in evidence. And that's the essence of a high win rate strategy. Clarity through alignment. Most traders focus on entries and exits, but the real power lies in reading the story the market is telling through its timing, its price, and its volume. When you can read that story fluently, you stop being the audience and start being the author. Cutting losses quickly increases the quality of your wins. That's not just a trading rule. It's a law of survival in this game. Every trader who's lasted long enough to make a living from the market knows this truth by heart. It's not the number of wins that defines your success. It's how well you manage your losses that keeps you in the fight long enough to let those wins compound. The moment you learn to slice through a losing position without hesitation, You begin to separate yourself from the crowd of hopeful speculators who keep praying for reversals that never come. The market doesn't reward hope. It rewards discipline. You can't control whether a trade wins or loses, but you can always control how much you lose when it goes wrong. That's where real power lies, in control. Ask yourself, how many times have you watched a small loss turn into a disaster because you refused to take it when it was manageable? How many times have you told yourself, I'll just give it a little more room, only to watch that little more turn into a much larger dent in your account? It's a painful lesson, but it's the one that teaches you what kind of trader you really are. Every trader remembers the first big loss they failed to cut. It burns itself into memory like a scar. That's not a bad thing. It's part of the education the market gives for a fee. You pay tuition through your mistakes. The quicker you accept that losses are the cost of doing business, the faster you can start thinking like a professional. A professional doesn't panic when he takes a loss. He shrugs, records it, studies it, and moves on, because he knows that keeping losses small gives his future trades room to breathe. Here's the truth that takes years to really sink in when you cut losses quickly. You're not just protecting capital, you're preserving mental clarity. A big loss doesn't just damage your account, it clouds your judgment. It makes you hesitant on the next trade, or desperate to make back what you lost. Either reaction destroys your edge. But when you take a small loss gracefully, you stay in rhythm with the market. You don't lose confidence. You don't lose perspective. You simply move to the next opportunity with your head clear and your discipline intact. That's how consistency is built. Now, let's connect this back to how it raises the quality of your wins. When your losses are small, your winners don't have to do all the heavy lifting. A trader who risks $1 to make 3 can be wrong more often than right and still come out ahead. That's the beauty of proper loss management. It magnifies the value of every winning trade. You're no longer chasing home runs to cover strikeouts. You're playing a steady, controlled game where each victory adds real weight to your account. Cutting losses fast gives every win more significance because it's not burdened by the damage of prior mistakes. Think about it like pruning a tree. You cut the weak branches early so the strong ones have room to grow. Trading is the same. A small, quick loss is a pruning cut. It keeps your capital healthy, your confidence strong, and your performance steady. The traders who refuse to prune end up watching the weight of their losing positions drag the whole tree down. You can't grow wealth that way. Growth requires trimming, discipline, and an understanding that not every trade deserves to live. Cutting losses quickly also builds trust in your own process. When you see yourself following your rules, without emotion, without hesitation, you start to respect your own discipline. That respect becomes confidence. And confidence, in trading, is oxygen. Without it, you suffocate under indecision. The more you trust your system, the easier it becomes to let winners run. There's a direct connection between your ability to accept small losses and your ability to ride big gains. Most traders never realize this. They think the two are separate skills, but they're two sides of the same coin. Remember how in that previous discussion about cutting losses and letting profits run, we talked about freeing your capital to flow where it's most productive. The same principle applies here. By cutting losses quickly, you free not just your money, but your attention and energy. You're no longer emotionally chained to dead trades. You can move on to setups with fresh potential. That's how compounding begins. Not just financial compounding, but psychological compounding. Every disciplined action strengthens the next one. The market punishes hesitation. When a trade turns against you and you hesitate to act, it's rarely because you don't know what to do. It's because your ego gets in the way. You don't want to admit you were wrong. But being wrong is part of being a trader. Every great speculator is wrong often, but never for long. That's the secret. When you learn to view cutting a loss not as failure, but as the cost of staying sharp, your entire mindset shifts. You stop fighting reality and start flowing with it. The tape shows you the truth every second of every day. Your job is to listen and respond, not argue. Let's be clear, though, cutting losses quickly doesn't mean cutting them emotionally. It means cutting them systematically. You don't panic out of trades just because price twitched against you. You act according to your plan. You define your risk before you enter, not after you're in trouble. That's what separates discipline from fear. Fear reacts, discipline executes. Your stop loss isn't a weakness. It's your lifeline. It's the line that keeps you from drowning when the tide turns. And here's something most traders overlook: small, frequent losses are actually signs of a healthy trading system. They mean you're playing defense right. They mean you're taking controlled risks, keeping yourself in position for the moments when everything aligns. The big moves, the real paydays. It's the same lesson I've learned again and again in my years watching the tape. The fewer deep cuts you take, the stronger you stay for the real battles ahead. Cutting losses quickly also changes your relationship with the market. You stop seeing it as an enemy trying to take your money and start seeing it as a partner giving you feedback. Each stopped-out trade is information. It tells you something about timing, about volatility, about crowd behavior. When you stop taking losses personally, you start using them professionally. Every cut loss becomes a clue, a note in your trading journal, a piece of data that sharpens your edge. So ask yourself, the next time you're staring at a losing trade, what's holding you back from closing it? Pride, hope, the fear of being wrong. None of those have ever paid a dividend. The only thing that pays is execution. Cut fast, cut clean, and you'll find that your winners start to shine brighter. Not because they're suddenly larger, but because your discipline has amplified their value. Every trade you take should have purpose behind it. Not impulse, not boredom, not the thrill of action, but purpose. There's a vast difference between entering a trade because it's right and entering it simply because it's there. Most traders never learn that distinction, and that's why they stay average. The market throws opportunities at you every day, but not every opportunity is worth your money. The best traders, the ones who last, who grow, who build real wealth, learn to wait for trades that meet their criteria completely, not partially. They understand that patience is the invisible weapon of a professional. When you enter a trade because it's right, it means you've seen confirmation. It means the market is showing strength or weakness in the direction of your plan. It means your risk is defined, your timing is aligned, and your conviction is backed by evidence. Entering because it's there is what amateurs do when they can't stand being on the sidelines. They see movement, and movement tempts them. But the market doesn't pay for movement. It pays for precision. Ask yourself, how many of your losing trades came from boredom rather than strategy? How many came from wanting to feel busy rather than wanting to be right? I've seen traders who could read charts like poetry, yet they couldn't resist touching the market when it was quiet. They'd take random setups, hoping one might turn into something. It's like a hunter firing into the dark, hoping to hit something he can't see. A professional never does that. A professional waits until the target is clear, the shot is clean, and the odds are on his side. Trading is no different. Every trade you take is a bullet fired. You can't afford to waste ammunition. The truth is, most of trading is waiting. It's sitting there, watching patterns develop, waiting for confirmation, and doing absolutely nothing until your criteria line up. That's the part nobody glamorizes because it's not exciting, but that's where the edge is built. You must understand that the market doesn't reward activity, it rewards accuracy. When you trade because it's right, you're aligning yourself with probability. When you trade because it's there, you're gambling on hope. One is skill, the other is emotion. You can tell a disciplined trader just by looking at their trade history. Their entries are few, deliberate, and precise. Their charts aren't cluttered with noise. They're not chasing setups every 5 minutes. They're hunting one thing, a clean, high probability opportunity where timing, price, and volume tell the same story. Everything else is ignored. It takes maturity to reach that point because it means giving up the illusion of control. You can't make the market move. You can only align yourself with it when it does. When I first started out, I wanted to be in the market all the time. I thought being active meant being productive, but the tape taught me otherwise. I learned that sometimes the best trade is no trade at all. Waiting isn't weakness, it's strength under control. It's the mark of someone who understands that trading isn't about constant engagement, it's about selective precision. You don't make money by forcing trades, you make money by recognizing the right ones and executing them flawlessly. The challenge is psychological. The market seduces you with motion. The charts move, the candles flash, and your brain starts whispering, you're missing out. That's the moment discipline is tested. You must remind yourself that the goal isn't to trade more, it's to trade better. You can't treat every setup as an opportunity. Most are traps dressed in disguise. Think about it, how many times have you jumped into a setup because you didn't want to miss out, only to realize moments later that the move was already over? The market rewards patience and punishes impatience with remarkable consistency. When you only enter trades that are right, you also create a cleaner emotional environment for yourself. Each trade becomes a calculated decision, not a reaction. You're no longer driven by the need to be in the market, but by the need to protect your edge. And when you protect your edge, you protect your capital. A trader who waits for confirmation before acting can lose small, but one who trades impulsively can lose everything. The beauty of selectivity is that it preserves both your confidence and your money. Now, remember what we discussed earlier about cutting losses and letting profits run. This ties directly into that philosophy. The fewer random trades you take, the easier it becomes to manage your positions properly. When you only enter because it's right, your trades have structure, logic, and discipline behind them. You know exactly where to cut your loss and when to let your profit breathe. That's the difference between a professional's mindset and a gambler's instinct. A gambler trades to feel alive, a trader trades to survive and thrive. The market has a way of filtering out those who can't control themselves. You can have the sharpest analysis in the world, but if you act out of impulse, the market will strip you of your profits faster than any bad call. Self-control is your only real defense. It's not enough to know what to do. You must also have the discipline to do nothing until the moment is right. That's what separates a good setup from a profitable trade. Every time you force a trade, you dull your instincts. You teach your brain that impatience is acceptable. But every time you wait for the right setup, you sharpen your intuition. You reinforce good habits. You start seeing the market differently. Patterns become clearer. Movements make sense. You stop guessing and start understanding. The market rewards that kind of clarity with consistency. There's another benefit to entering only when it's right. You trade with conviction. You're not second, guessing yourself mid. Trade because you know you followed your plan. That confidence keeps you steady through volatility. You're not shaken by every tick because you didn't enter on a whim. You entered with purpose, with evidence, with intent. And when you trade with intent, you naturally manage your positions better. You take profits at the right time, you cut losses when needed, and you avoid emotional decisions. Ask yourself, what kind of trader do you want to be? The one who trades every flicker of movement, or the one who waits for the moment that matters? The answer to that question determines not just your win rate, but your longevity in the market. Because the truth is, trading isn't about constant activity. It's about selective accuracy. Every great trader I've ever known learned this lesson the hard way. The market doesn't care how often you trade, only how well you do it when you do. So the next time you find yourself itching to take a position, pause for a moment and ask, am I doing this because it's right, or just because it's there? The difference between those two answers is the distance between speculation and mastery.